Under the perpetual inventory system, we will record inventory sales or inventory changes every time we have a change in inventory. So when we record this sale, we're going to have two components to the sale. We are going to have the cash debit and the sales revenue credit, which you would expect for every sales transaction, by the way. But with the perpetual system, you will also have this second transaction, which is a cost of goods sold and inventory transaction. This is automatically generated by the system as the merchandise is being scanned. So if you are making a purchase at Walmart for cash, most sales aren't cash now, most are on credit card, but let's say it is a cash transaction. You as a customer comes in, pays the $400 in cash, and the merchandise which you're purchasing, you're going to pay for $400. So that's the first A transaction. But there's also a second transaction that's going to be recorded when the merchandise is scanned, and this is taking the inventory out of the inventory account for its amount of cost, which was $350, and recording a cost of goods sold transaction. Some of you are very keen on your accounting, can tell me what this is. This is another example of expensing. Right, it's expensing of an asset. You are expensing off the inventory account, the inventory asset is being removed, and you're recording an expense, which is cost of goods sold. With the perpetual system, these two transactions are automatically done. Now, if you had the periodic system, the first transaction would be done, but the second would not be done. Instead, we wait until the end of the month and we count up our inventory and we do one journal entry for all the transactions at the end. That's under the periodic. This, again, is perpetual, the system that most companies use, automatically generating the two journal entries, the revenue transaction and the cost of goods sold. Now, by looking at these two transactions or these two journal entries, which is from, I guess, one event being a sale of merchandise, you can also see gross profit in this, couldn't you? The gross profit from this transaction is $400 minus $350, or $50. So the first is selling price, the second is the cost, and this is the cost of those merchandise items which are sold at this point in time. An example here then, this is just using the words for what we just saw previously. They're selling two mountain bikes, a selling price of $200 a bike, so $400, and they originally cost $175 each. So if we analyze the transaction, we would be seeing that, well, yes, we're getting in $400 cash, we're removing inventory, which was $350, and then in the stockholders' equity section, you see again those two transactions that flow through the income statement, flow into retained earnings, revenue, and cost of goods sold, and the other two is a $50 change there. So it gets recorded as we have discussed. Sales returns and allowances. These are really the opposite of sales. So I want you to think up here sales returns, and the other word is sales allowances. Let's say a customer has an item that they're not happy with. They can return it. Walmart is quite generous with refund or return policy, so they return it. Well, we have a number of issues with them returning, don't we? We have the notion that really we haven't done what we needed to do to earn it anymore because it's back with us, right? The other thing is, if it's back with us, it should be probably put back into inventory. And if it's not recorded as a sale anymore because it's returned, we probably shouldn't record the cost of goods sold either. So this is why I'm saying it really should be handled as the same thing as a reverse sale. So these two Schwinn mountain bikes, we have one of them that's going to be returned, and the customer is going to get the full refund, assuming that this merchandise is in good condition. It comes back in the store. We are going to give them back the cash for half of the purchases. You know, they originally purchased 2 bikes, $400 total. We're only going to give them $200 because they're only going to return one of the bikes. We also need to note that we have this back in inventory, and we put it back in inventory at the thing we took it out at inventory at. So it was $350 for 2. For the one returning, it would be $175. And cost of goods sold, it needs to be reduced or removed, so we are crediting an expense. This is one of the few examples when you credit an expense. The other thing to note here is they have a plus XR by this sales returns and allowances, because sales returns and sales allowances could be one account, could be 2 accounts, could be sales returns, it could be sales allowances. Here they are combining it, calling it one account. This is a contra account. The contra account is going up, which means the sales account is really going down. And we are going to include sales returns and allowances as a part of our net sales. The other thing that's going to happen here is this customer we're going to sell to is going to pay us, and they're going to pay us later. So we're going to let them leave the store, and we are going to let them send their money in later. This is an accounts receivable. If a customer pays with an accounts receivable, then we can, as we were given a discount when we had a purchase, and we called it an accounts payable, and we called it a purchase discount, if we are having sales, we can also give our customers a sales discount. And how do you handle a sales discount? Well, a sales discount needs to be reflected in the different amount which is going to be received in from the customer. Let's first handle the sale part, though. This would be not recording it as a debit to cash, but recording it as a debit to accounts receivable because the customer is putting it on their account. The cost of goods sold and the inventory account is just like we saw a moment ago. This $700 represents the cost of the inventory item that is being sold. If they pay within the discount period, this is the transaction I wanted us to see. We have $1,000 in accounts receivable which we set up. We are going to remove that. We are only going to get in cash in of $980 though, because there's this $20 discount that we are giving them. The $20 represents a contra amount to sales, so it is recorded as a sales discount in a contra account which flows through into net sales. In this case, because sales revenue is a credit account, this is a contra account, it will be a debit. So we're going to debit it for 20. This is very similar to what we just did earlier. Instead of recording it as a sales discount, we called it an inventory adjustment. Instead of receiving cash, we paid cash. Instead of accounts receivable, it was accounts payable. So this relates to having a customer buy our products. The purchases discount we talked about previously was when we were buying merchandise. You can think of this as two different sides of the same sort of transaction. So we can summarize, just as we did for the purchases, we could summarize all the sales transactions that have happened. We had the initial sale of $1,400. We sold those 2 bikes, and then we also had the paper. Then we had the customer that returned the bike, which means we cannot say we earned this $200 of this $400 anymore because the bike came back to us. It would be inappropriate for us to continue saying we earned it if it's returned. Now, we also had a sales discount which we gave to this customer because they paid their accounts receivable balance on time. Well, we're going to deduct that too. and call it a sales discount. Notice again, they're calling this return bike, they're putting it in this one account called sales returns and allowances. Technically, this is a return, this is sales return here. Companies may have two accounts, one for sales returns, one for sales allowances. Companies can't have one account where they put both of these amounts in it. That's the case with this company. Cost of goods sold also needs to be adjusted. It needs to be adjusted for the fact that this returned bike happened. And we also have costs associated with several items. We have the two bikes and then we have the paper. So the cost of goods sold in here comes from two sources and it is reduced for the item that was returned. This gets us down to gross profit. So again, the important thing in a merchandising firm is to emphasize the difference between their sales, net sales, and cost of goods sold and the gross profit. When we look then at a multi-step income statement, it's called multi-step because it's not just revenues minus expenses anymore. It's net sales minus one type of expense, which is cost of goods sold, and then it lists out all the other expenses separately kind of below. So they're combining some of these into broad categories. They're calling a bunch of different expenses selling, general, and administrative expenses. The multi-step comes about because you subtract, then you subtract again, then you subtract again, then you subtract again, and so you go through steps. Okay? You go through steps, and that's why they call it a multi-step. And they are putting side by side 3 consecutive years of numbers so that comparisons can be made. This is the top part, the first step. And again, this is the gross profit area, which is most important for merchandisers. If you don't have money here, then when you start subtracting things, it quickly becomes a negative number. So therefore, this number has to be very big to cover all these subtractions that are going to happen, or else your net income becomes negative. And that's the whole point here, and that's really the emphasis in merchandising, is to get this gross profit number as high as possible. Now, I said earlier that there was a number called margin, and I said this is different from gross profit. Here in this set of PowerPoints and in your textbook, they're calling margin gross profit percentage. And what gross profit percentage is putting the gross profit number, this number, on top, putting it there, and then putting the net sales, which is the top number, on the bottom, multiplying by 100 to get the percentage. Alright, why is this important? Well, what it is saying is what percent of all your sales remains in gross profit. Again, the bigger the percentage of this at the top, the more you have to available to cover your general selling and administrative expenses, your income taxes, your interest, your other items. So we want this percentage to be as high as possible. Here is the calculation for Walmart then. Doing the calculations, you see 24.5% is gross profit as a percentage of sales in 2012. 2014, it's only 24.3. You're going to say, well, this is not good. This is going down. I thought you wanted this number to be big. I thought you wanted to keep it high. For Walmart, this number has deteriorated a bit, but it hasn't changed much in 2013 to 2014. Therefore, I wouldn't be so concerned with it. You're also going to compare this number to what other retailers make, and that's fairly a common thing to do. So Walmart's numbers would be compared to, say, Target's, to Dollar General, to other similar stores. There's a difference in these numbers by industry. Notice florists, they're making 53.6%. So when they sell flowers in the shop. The flowers are marked up quite high compared to their costs. Sporting goods also high. Gas stations relatively low. And if you look at net income, not gross profit, if you look at net income as a percentage of sales, grocery stores it's only 4%. So 4% of every revenue dollar is in net income for grocery stores. Amazingly low. And here with gas stations, you see, they would have to sell a lot of gas to make high net income. Now, under a periodic system, I'm going to go through this just very, very briefly because most stores do not use the periodic system. But I want us to go through and just kind of see how the differences play out. If you use a perpetual system, you record transactions, a purchase of inventory goes into accounts payable, you have sales, and when you have sales, you're also recording cost of goods sold at the same time. When you have a periodic system, you don't have this journal entry being done. And you don't have it being done because it would just be too difficult to do. And to think about this and how it's being played out within the store. If you have a perpetual inventory system, you're scanning, and the computer can go to the records and it can pick up what the inventory costs, and it can just generate this journal entry because the merchandise is being scanned. If you have a periodic system, you don't have the scanners working. You don't know the particular inventory item that's going out, and so you can't go in and you can't remove the cost for that inventory item. And so the periodic inventory system is just unable to do this cost of goods sold entry, which means when the merchandise leaves, the merchandise is not credited here as it is credited under perpetual. In periodic, there's no journal entry done here because there's no scanning. So that's the difficulty, and we said it's not as effective, not as efficient. Your company will probably not be as profitable under this periodic system. What's the point in this slide? To understand there is no cost of goods sold entry under periodic. Now, under the periodic system, though, this important equation still holds. That is, beginning inventory plus purchases minus ending inventory is cost of goods sold. So we can use this equation to calculate cost of goods sold. We aren't debiting a cost of goods sold account to create it as we make the sales, but we can go through here and take a physical count of our ending inventory, determine what that is, subtract it here as in the equation to get cost of goods sold. So that's what you have to do under the periodic system. And if you do this, then what's going to happen is at the end of the accounting period, you're going to go through and you're going to adjust your accounts so that your account balances are brought into their proper balances. I usually combine this all in one journal entry, and when I do the journal entry, then I establish my new ending inventory number. Their ending inventory number needs to be $6,000. They need to remove their beginning inventory number, which is $4,800. So the balance in inventory was $4,800 at the beginning of the time period. They're going to remove it. They're going to establish a new inventory number, and they're going to determine that cost of goods sold is going to be adjusted, and cost of goods sold should be $9,000. A debit for $15,000, a credit for $6,000. The net effect is $9,000. Again, I would probably combine it into one journal entry, but this is the way they do it. This is done at the end of the accounting system. So we're not doing this inventory, credit, cost of goods sold, debit like we do under perpetual, under periodic. We wait till the end and we make things work based again on this all-important two equations that we combined. So end-of-year adjustments are not required using the perpetual inventory system. We could go through and we could look at this whole thing and analyze it if we liked. It's not really necessary. What you really need to understand from all of it is what we have just discussed, that under the periodic system, you're going to go back at the very end and you're going to find a lot of transactions being recorded at the end to make things work. And here you see it all happening over here. Versus over here, it's not the same.